So welcome to the first ever episode of LeaderOne Live, brought to you by LeaderOne Financial. I'm your host, Alice Lund. So the mission of LeaderOne Live is we're planning to host mortgage professionals, both inside and outside of LeaderOne, and have conversations about the challenges and the opportunities that we're most interested in today. So we'll see where this takes us. I'm really excited. So joining us as our very first guest is our Chief Capital Markets VP, Todd Lennon. So Todd, this isn't where our journey actually began together. We have chit-chatted in the past on a little thing I think we called Capital Markets with Todd and Alice. So I'll say you're back by popular demand. And not every topic is going to be as mystifying as the topic today, because we're going to talk about mortgage rates and mortgage margins and affordability and why everything is kind of seeming so hard to understand. So welcome, Todd.
Hey, Alice. Thank you for having me on your first live show. So we're in a weird market right now. It's hard to predict.
It's hard to predict, and I was thinking about this as I was preparing for today, and I thought there's been a lot of times where I've sat through presentations and I've given presentations where I've tried to help people understand how to predict, where interest rates are going to go based on what happens in the markets and what's happening with the short-term rates and the treasury rates and all of that. And it seems like, historically speaking, interest rates are easy to predict, and they follow what we would call a somewhat predictable, trend. So why is it that even the brightest minds over the last 8 quarters, it's been so hard to know where we're going and when? We had the refi boom of 2024 that lasted all of like 2 weeks, and we all got excited, but here we are. So is it that interest rates themselves are hard to predict, or is it that we don't know what's going to happen with the economy and with policy? Maybe we should start there.
I think so. 2020 was actually not normal either. But if you look historically, prior to 2008, before that, we actually had cost of funds that were pretty, fairly high compared to what we saw once 2008 hit, and then you got the financial crisis, and there was a lot of monetary stimulus that took place. Fed dropped rates extremely low to get us through the financial crisis, and then rates lifted a little bit, and then 2020 hit, and with COVID, there's even more stimulus, and this is something that most mortgage bankers and folks that follow fixed income interest rates, this was new. It was new to the Fed. They injected tons of liquidity in 2020. And then something snuck up that made it quite interesting was inflation actually started to hit the main street. And the Fed kind of freaked out, and they cut dramatically. They cut dramatically prior, but once the inflation hit, they increased dramatically. And that was like around December 2022. And so ever since then, we're on this crazy tightening cycle. And when I say tightening cycle, just increasing rates to make the cost of capital more expensive. And go ahead.
Oh, so yeah. So just so far you're talking, it's interesting because when we talk about historically speaking, it's almost like we have to factor out everything before 2008, because there is this whole historic line. And so it's almost like there's it's modern historic times, because I think, like the Great Recession, when all of that happened, since then, it has been, there's been a lot of stimulus and lower interest rates and everything. We're not back to 17%, but the affordability is a challenge because, houses have gotten so expensive.
Yeah, and that's the inflation piece that hit whenever, to borrow money got cheaper and cheaper. They were able to lift property values and compete with cheaper money. And so once 2022 hit, the prices of homes didn't change, right? But the cost of capital did, and interest rates went up in 2022. And that put a major pause on the volume of mortgages that we could do as IMBs. So right now we're kind of, we've had our first loosening of 50 basis points in 2024, but you still look at the data, inflation's still kind of hot. And I think why it's so unpredictable is we haven't seen inflation like this for 40 years. And so, whenever they tightened, I don't know if they realized how painful it was going to be for the mortgage world. And part of the problem was there's not enough supply. Like, one way to make housing cheaper is to have more supply, just simple demand and supply fundamentals. And in 2022, whenever they were trying to stop inflation, unfortunately, it also affects the price of buying a home. And
yeah, so typically, like if interest rates are going to go up and go up as dramatically as they did, then you would anticipate or expect, if there wasn't such a supply issue, for prices
yes,
actually come down a little bit and for things to get
yep,
easier that way. But that's not the case. We know that we have the
yeah,
largest population of wanted home buyers the nation has ever seen. More people,
right. And
68 million
we
is
haven't
like
been building
millennial.
enough.
Yeah.
Yeah, we just haven't been building enough, and that's something I don't think that our industry is familiar with, and that's what's caused a lot of the pain that's occurred.
So we stayed too low for
So
too long, probably.
too
And
low,
then,
too long, moved it really, really fast with no supply, the rates up. That's the recipe for pain for us mortgage bankers. But loans are still getting done, right? So it's just not it's not what we were used to. I mean, it depends on how long your memory is, right? If your memory was 2020, those heydays aren't occurring right now, and I don't see rates ever coming back to those levels. So,
yeah, without, I
but
guess, government intervention again, and hopefully we don't get that kind of stepping in quite like that again, because it did kind of create a monster
yeah,
a little bit.
it
And
did
but
create a little.
and loans are still getting done, but there's been, I think that mortgage banks, and I mean, this is a lot of your job. If you've got an impossibly difficult job that we'll get into on another episode, just what you do on a daily basis to keep us where we need to be. But is the profitability and the margins that mortgage companies are able to make on their loans.
Yeah, so it was a little bit of a double whammy, right? Like, volume tightened because the supply and the cost to get into a home. Um, but at the same time, there was a squeezing of margin occurring during that same period. So, it made it double painful to have no volume and lower margin. And the lower margin has a lot to do with how the MBS securities trade. And right now, we don't have the stimulus occurring by the Fed buying, right? They're kind of talking about, letting runoff occur on their balance sheet, and they're not really wanting to stimulate more at the moment. We'll see where that goes. But so then you have more organic buyers of mortgage-backed securities, and they don't have the same amount of money, right, that the Federal Reserve has to put on their balance sheet. So that created a difference between the trading of MBSs, the spread of MBS cost, or what they expect for extra premium. That increases rates. So the rates spread between, your typical conforming 30 product versus the U.S. Treasury, it didn't completely tie the same way. They didn't trade the same way, which is another confusing thing for loan officers and borrowers, right? They're like, whoa, rates should come down. And,
so
they hear about.
talk to us about that a little
Go
bit
ahead.
more. And let me just if I understand what you're talking about, you're saying that like the spread between where rates basically are expected to be based on where like the 10-year treasury is and stuff, there's more of a spread there than maybe.
Yeah.
Okay.
Like, typically you would see, if you look historically, through a long period of time. I have a chart actually that I wanted to show, and I'll show.
Yeah,
That,
this is important, Todd, because this is something that, like, as lenders, we're out talking to our realtor partners and to our clients about the fact that, servicers, there is some sort of a risk-based premium baked into the rates right now because servicers are afraid that, thinking, okay, rates are going to come down. They're not going to get there 2, years, 3 months or whatever it takes them to make their money on, holding a loan. And then they're worried more about defaults probably now a little bit. And so, we're thinking, okay, when rates come down a little bit, maybe some of that will wash out and then we'll get that additional, lowering of rates. But, maybe the chart will help to explain whether or not that's even the case. And if it's something we should maybe stop saying.
Yeah, here, let's show this chart. And basically this is the historic. If you look at the top graph, you can see rates, the mortgage-backed rates are the orange line at the top, and then your 10-year treasuries, that blue line below. So when I was talking about the spreads between rates of traded mortgage bonds and U.S. treasuries, as you can see, when you look at that line, the space in between is the spread. And if you actually look below the line or below that chart, there's another chart right here that's red, and that's the actual spread that you see between those two interest rates. And there's really like two reasons. The mortgage-backed security is not the same asset as the U.S. Treasury. Like the borrower of a treasury is the government, right? Whereas mortgage-backed securities, the borrower is going to be your borrower, your home buyer. So yeah, the difference between those two borrowers is what creates that spread. If you kind of take a look and you averaged out the spread at the bottom, you'll see a line, a straight line that goes across right here. And that straight line represents just the average spread. So the average spread
line down here. Yeah.
Yeah. Okay. That average spread has been 1.75, right? Well, if you look on the very right-hand side, you can see that red line has popped up, right? It's pretty dramatically different. So when I was talking about margin leaving, right, that is the margin that left, just the security piece, right? And that has to do with, well, rates are up high. If rates decide to start, coming back down, there could be a refinance by borrowers. So the MBS holders, they're worried about paying too much for an MBS security that's eventually going to pay off by a borrower, because as we say, we can't really predict what the Fed's going to do. I mean, I don't even know if they know what they're going to do, right? So the way that MBS buyers hedge themselves is by adding more of that interest rate. And the other component of that is, well, there can be a default on a borrower that would be paying their principal and interest that goes into a bond. Whereas the US government, they're going to keep, funding and borrowing through treasuries, right? So the treasuries, they use treasuries to pay off old treasuries. But as a treasury holder, you can expect your principal and interest to be paid through the length of the actual bond. And this is 10 years, right? So, if you have a US Treasury buyer, they're like, okay, well, that's going to be around for 10 years. They don't have to worry about the prepayment risk. They don't have to worry about the government defaulting. Whereas mortgage-backed securities, they do, as a buyer of mortgage-backed securities. So that's what creates the differential between the two interest rates. And it's a concept that, I'm privy to because it's the world that I live in. Whereas in your world, and, real estate agents and borrowers, LOs, people that are trying to run production, big divisions, that's different for them to see that stuff. And they don't necessarily see what I see, but they feel it. And the feeling of it is, this is a tough market. So hopefully that kind of explains.
It does. And I mean, on the sales side, of course, like we would want is, the minute that some of that risk-based, pricing is washed out, we would want rates to just drop down. But the truth of the matter is that we really need to be able to look at making sure our IMBs are profitable again. and it
Yeah,
would
I
all
mean,
play nice and like, like get back some of that margin when some of this like washes out, then that would make things a lot easier for our industry, I think, as a whole.
it would, but I wouldn't hold your breath, right? Like when you're running a business, try to close those deals and don't try to anticipate where rates are going to go. Like
Yeah.
in my world, I don't really anticipate where rates going. I see where they go, and then I adjust what I do based on where they're at today. Like I just need to make sure I'm on my game today. I feel that's the same for being a loan officer. Hey, get that home for your borrower if they can afford it. And then if something, the money tree comes back, well, then you can always refinance. But it's that home decision, to me, that's more important. But that's we want more whenever we work in this industry, right? We want more products being sold. We want more borrowers to buy more, but we got to understand it's a tough environment.
Yeah, and I mean, I think you buy the house when you buy the house, and there's a lot of Americans out there that are sitting on low interest rate mortgages, but they have high interest rate credit cards and a HELOC at 10 or 11%, and a car loan at 9%, and a lot of there's a lot of people that can benefit from refinances, and we have there are so many great aspects of the market we're in today. We've got tons of people that want to be a homeowner. We've got tons of home equity. We've got, we've got, excellent programs, and there's all sorts of opportunities. So we know
Yeah,
that housing is going to be strong.
I think there's something that borrowers should look at if they're holding like lots of credit card debt just because bills are so expensive. Well, their home has increased dramatically in value. And in today's environment, I'm seeing more and more investors offering closed-end seconds where you can pay over 30 years to tap some of that equity. And I think, you got folks that have those 3% rates, right? And they don't want to get rid of it. But they can still use that equity that's inside their home and take advantage of the fact that the supply is low at the moment and just use that money for short term. And then, whenever you fix your financial situation as a borrower, pay it down, right? And maybe a different environment. But I think that's something new for loan officers, right? They say, "Oh, just go to a bank, get a HELOC." Well, no, there's other options out there where you can actually lock in part of your equity over time, and then pay a payment that the day you sign the docs. So there's options.
There's options and something, and I'll have to have you back. We can go over loan level price adjustments because those are huge for cash out refinances. And so something that we've been talking to people about is you get that first and second, maybe that makes sense, but maybe doing a cash out refinance now. Yes, you let go of the 3%, but maybe you get a 6.5%, a 7% now, and then when and if that refinance market comes back, you're looking at being able to do a rate and term rather than a cash out.
Yeah, there's two options. You could do the cash out, like you're saying, but sometimes the cash out, borrowers are very proud of their low rates,
Yeah.
and that's a very hard thing to overcome. So, you as a loan officer, you're kind of a financial advisor, and the main asset that you know the most about is their home, right? So, structuring financing that makes sense for them, there's options.
For
So,
sure. And a conversation I've had with some people is, what you've got all of this equity because we had these really low interest rates, and it was crazy that how much homes appreciated during that time. But in order because of that, and the reason you got all of that equity, we had to cure it with higher interest rates. And so if you have to wash out some of that extra equity with consolidating some of this debt you've got because all of a sudden the world got really expensive because of all this inflation, it's kind of a wash. So much interesting
yeah,
stuff to talk
yeah, you
about.
just have to figure out. You have to figure out in each market where does it make sense. There's always a strategy. In every market, there's a strategy. It's just sometimes you have biases of what you think you should do and not do, and
100%.
sometimes you don't. Sometimes those biases work for a very long time, right? Until they don't, and then you have to, figure it out. Figure out what's the next decision that will make more sense in this market. So.
I love it. Well, we could talk all day, Todd, and we'll have you on again soon. So thank you so much. This is, of course, probably the hottest topic in the mortgage industry today is rates, why we're here, where we're going. And so just thank you for everything you do for LeaderOne and for being our very first guest today on
Yeah.
LeaderOne Live.
Thank you for having me, Alice. Appreciate it very
Absolutely.
much.